But I do want to start with the gold story. And it can be tempting to see the headlines, see the queues outside the gold bullion store on Martin Place and go, shouldn't we be selling here? This is an all-time high. Well, gold's been hitting all-time highs since the 2020s. In fact, most markets that trend upwards, and they're the ones you want to be investing in, will continue to hit all-time highs. And you should never shy away from that. To think about gold in terms of returns is sort of the wrong way of looking at it. Just want to spend a little bit of time going through the rationale as to why we do what we do with gold. It is a bit of a divisive asset class. The great Warren Buffett, who's just retired, said that gold is just about the last asset he'd ever want to own. Whereas Ray Dalio, famous hedge fund operator, said that the only reason not to invest in gold is if you don't understand it. And you just don't understand the economics. There is no sensible reason to not include it. I think I would fall somewhere in the middle of those two extremes. But we have at Sherpa consistently for a decade, and I personally for 20 years have included gold in my portfolio and the portfolio that we manage for our members. Pre-2007, that was a harder tool to do. You needed to do it with physical gold or to try and simulate it using gold mining stocks, which don't quite behave in the same way. But 2007 saw the launch of the gold ETF, and that's today how we deliver our gold allocation. So this is just putting the last couple of years' returns in context. This has been 2 years of great performance where gold is up 6 times since 2007, which was the launch of the gold ETF, but that really has accelerated since 2022. But like I said, that's not the real story. Gold, think about it as being a defensive asset there to smooth out the ups and downs in your portfolio without giving up too much by way of returns. And it does this in 2 ways. So generally when markets decline, investors across the world flock to the US dollar as a safe haven, which has the effect of pushing the US dollar up relative to most other currencies. And that's the black curve on this chart. So that shows that in these market circumstances, and I've just tracked most of the reasonable declines since the GFC, and that pushes the US dollar up. The Australian dollar, being a commodity currency, usually gets hit worse than most. So if you're a Canadian, South African or Australian, this is a big story for you. And so US dollar rises, Australian dollar falls. So assets like US shares, or most overseas shares generally, because they're denominated in US dollars, that value goes up, which offsets the fall in the US dollar price of those assets. That's the argument for investing in overseas shares generally and not hedging the currency, because part of the benefit in investing overseas is you get this currency damping, which helps smooth out your portfolio. And gold does sort of the same thing, because investors in tough times go rushing for the security of gold. So the gold price goes up. Gold price is denominated in US dollars. And so you get this double whammy for Australian, Canadian, and South African investors. That's part of why you're not going to see this story play out when you watch content on the internet, because most of that content is US. Neither of those two phenomena play out for US investors who are investing in US dollars. The gold price obviously has the effect, but you don't get that double whammy. So here what we're seeing is that the black line shows, starting in 2010 at the left, share market falls. That's the gold colored graph, and US dollar goes up. And then you overlay on top of that gold going up, and you get that double whammy. And we see the same thing play out in 2011 and in 2018 and in 2020 and in 2022. I haven't quite seen it in 2025 because 2025 was generally an up year. So it's not often that we see gold rise at the same time as equity markets being strong. That's really a reaction to the geopolitical instability that we're seeing, and to an extent, the concerns about the US deficit, which remains stubbornly high. And it's been stubbornly high for a very long time. I remember when I was in business school in 86, my thesis was on what they used to call the twin deficit, the current account deficit and the budget deficit. The US had been running deficits for years. And since 1986, that's almost 40 years ago, they've had 2 years of surplus. Whilst in theory, the US, because it can print more US dollars, it's probably not too constrained by borrowing. But nevertheless, the US debt service, because the government has chosen to borrow it, not to print it, is now more than the defence budget. And that's an unusual position for any major economy to be in. But nonetheless, this just shows markets get the wobbles, US dollar goes up, gold goes up, double whammy for Australian investors. So that's the theoretical backing for why we do what we do. But I just want to take you through what it actually looked like as we went through the last few downturns. Obviously, the GFC, 2007, 2008, in fact, all the way through to 2010, 11, really, was the last prolonged downturn that we've seen, and that's now 17 years ago. And upside since 2010 means that most investors under 40 have never seen a situation like this. So it's very easy to be an aggressive investor. To paraphrase Mike Tyson, everyone's an aggressive investor till he gets smacked in the mouth with a deep and prolonged downturn. I'm not wishing one to happen, but you've got to expect that these will happen 3 times in every 20 years at least. So in your investing career of 50 years or more, you have to expect to see a half dozen of these potentially, and making sure your portfolio is positioned to weather these and for your mental state to allow you to stay the course is the key to getting this right. So GFC, what we saw was that the share market peaked in November 2007 and hit this long grinding downturn with a big shock in September of 2008. But it kept going down till almost 2010, and we see that gold went in the opposite direction. So in that period of almost 4 years, you've got almost a 60% difference in returns. Charts do look quite different. So obviously you wouldn't have had 50-50, but 10% gold would have weathered that downturn quite a bit. The next time we saw a market dislocation was in 2018. As governments tried to wind back on the liquidity and support for growing economy. Bit of a mixed year. So we had a decline in the first quarter and we had a strong period in the middle of the year, then a strong recovery to the end. Again, gold is more or less tracking in the opposite direction to the share market. In all this case, I'm using the ASX 200, that's the 200 largest companies on the Australian share market, as a proxy for the market. You'll get a similar result if you use the S&P 500 or the MSCI World. But generally what we're seeing is that the two move in opposite directions, and that's how you get the benefit. COVID was another really strong example. We had that very sharp decline. Market peaked in February of 2020, and we had that really sharp drop into April when it all started to look pretty scary, and then the slow grind up to end the year almost square. Certainly the financial year to June 30, 2020 was a positive, net positive, and the ASX 200 ended up the calendar year pretty well square. The US recovered a bit faster, but of course gold went in the opposite direction in US dollar terms. But over the year, both effectively returned to zero return. 2022 was a really interesting year that's interesting in the Chinese, may you live in interesting times sense, that both bonds and equities both fell. In fact, that was the first year in either ever or in the post-war period where both delivered negative returns, and gold came along and delivered a modest return, which meant that the life Sherpa portfolios were still down, but only down modestly. So that's really the story. 2025, I've added the S&P 500 here just to show the US situation. So over 2025, and this is the end of June, where you see the S&P 500 at the bottom one, it just recovered. So from the peak in February, we ran down through the April dip into Liberation Day and then a slow grind upwards. The Australian market recovered far more quickly to end the year up. And of course, gold was up strongly for the year and went in the opposite direction of that dip. This is the real story for gold. The fact that you got a 50% return this year is sort of academic. And it is our first port of call for defensive assets. So when we go from 100% growth to 90% growth, the first 10% is filled by gold. And it does give you better diversification than bonds. So this graph just shows for all of those years what happened to bonds and gold. So when we look at the 21-22 period, when we're having that strong recovery out of COVID, gold went backwards. So people were getting relieved, the world was back into track, and bonds were down, gold was up. And that's sort of interest rates recovering. So as interest rates went up, bond prices fell, but gold was strong. Whereas in the early part of this is 2015, bonds were up and gold was down. So it just gives you that better diversification than bonds. So that's really the gold story. It's generally a very different story to the bond result, even though most people would start with bonds as their defensive allocation. So traditionally, you'd have looked at a equities and bonds portfolio. Today, we go a bit beyond that. We use real estate and infrastructure as a slightly defensive growth, and we also use gold on the defensive side.